Is the market setting up to put in a major top in 2024? Let's find out. Before we take a look at whether the market is setting up to put in a top in 2024, let's take a brief look back at what has led to the present time. So if we go back to 2018, the Fed tried to raise interest rates. They tried to normalize interest rates. In September or October of 2018, Jerome Powell said rates were nowhere near neutral. The market didn't like that. The market crashed essentially in the fourth quarter of 2018, losing 20% in the fourth quarter. It bottomed on Christmas Eve. Powell came under a lot of political pressure, and in early 2019 he said, just kidding, we're not going to raise rates. And the market's like that. The Fed ended up cutting rates 3 times in 2019. Stocks rallied, bonds rallied, gold and the dollar all rallied together. And they rallied all the way through 2019 into 2020. And then COVID showed up on the scene. And in March 2020, the world shut down and assets crashed. The S&P 500 lost 35% in 23 trading days. And in late March, I think it was March 24th or March 23rd, one of those 2 dates, Powell came out and said, hey, we're going to buy everything. We're going to buy bonds. No bonds are going to default. The Fed is going to buy them. And asset markets love that, and they took off from that point forward. And they ended up gaining 130% from the bottom of the COVID sell-off to the top in late 2021. So throughout 20 and 21, you had this unprecedented stimulus that was being unleashed on the market. You had the Fed with very easy monetary policy. You had the federal government giving direct-to-consumer stimulus payments, but you also had widespread supply chain disruptions across the world. And so all of that easy money plus supply chains that were disrupted led to pretty substantial inflation. It was painful inflation. And it got so painful that the Fed had to do something that they don't like to do, which is raise rates. So inflation was so high that the Fed had to commit to raising rates just to restore their credibility. And so they started raising rates in March of 2022, but the market anticipated that and started to sell off in January of 2022. Stocks and bonds sold off together in 2022. Stocks bottomed in October. So basically they had a 10-month sell-off. Now at that time in October, everyone thought stocks were going lower. Retail traders didn't want to have anything to do with equities. Most people thought a recession was imminent, but institutions were basically backing up the truck saying, hey, retail traders, you don't want equities, we'll take your equities. They were preparing for a soft landing. And interestingly, the market bottomed in mid-October on a very unfavorable inflation report. So the market bottomed on bad news. And in late 2022, institutions kept positioning themselves for a soft landing. They bought equities, they sold the dollar. And that brings us to 2023. So let's take a quick look back at 2023. This is an annotated chart of the S&P 500. So stocks started off the year by rallying in January. The NASDAQ 100 was up 12% in January. Now, typically when an asset market is up that much, in only a month's time, institutions would sell that rally because it's too much, too fast. And retail traders would buy that rally because retail traders are price followers. Market goes up, they buy, it goes down, they sell. But that wasn't the case in January of 2023. Retail and speculators both thought that, hey, this is just a bear market rally, the market's going to turn around and go lower. But institutions, they kept buying even as the market was going higher. And what ended up happening was after a short pullback that basically culminated in Silicon Valley Bank collapsing. So the market rallied in January into early February, then it pulled back throughout February into the middle of March. Silicon Valley Bank collapsed, and then you had this massive rally in the S&P 500 and especially in the NASDAQ. So the NASDAQ, the Magnificent Seven, the mega cap tech stocks essentially single-handedly carried the market based on the market pricing in the benefits of artificial intelligence. So we had this AI boom from essentially March until July. Now in July, as the market was, or June and July, as the market was rising, institutions were selling into that rally. Retail traders and speculators were buying, but institutions were selling them the stocks that they had bought at the bottom in October of 2022. So then from July through October, the market sold off, and that was driven by a very strong rise in interest rates. So the 10-year yield went from, I think, 3.8% all the way up to 5% at the end of October. And in the middle to late October, the S&P 500 was down 6% in 8 days. Things looked a little bit dicey. It bottomed on a Friday, and everybody was wondering, okay, what's the next week going to bring? Is the market going to go even lower? But the next week came, and the Treasury Department released its prospective borrowing needs for the future, and everyone was expecting that there would be a lot of supply of long duration bonds, 10-year bonds, 30-year bonds. But Janet Yellen, the Treasury Secretary, said, no, we're going to shift a lot of our borrowing needs to T-bills, to the short end of the curve, and we're not going to issue as much in the long duration buckets. The market loved that. It calmed the market's nerves. The market took off. That was on November 1st when Yellen announced that to the market. But the market seemed to have anticipated that because it rallied on Monday and Tuesday. That information came out on Wednesday. By Friday of that same week, what is known as a Zweig breadth thrust triggered. Now that has to do with the number of advancing stocks relative to the total number of stocks, the average of that percentage going from a very low level to a very high level over the course of 10 days or less. They're very powerful signals. We'll talk about those more later. It factors into our outlook for 2024. So that was on November 3rd. On November 14th, the CPI report for October came out, and inflation in October was less than expected. The market rallied again, and then it kept rallying into the beginning of December. At the beginning of December, Jerome Powell was at Spelman College. He was doing a question and answer session, and someone asked him about rate cuts, and he said, hey, it's premature to speculate about rate cuts. And okay, so then there was a 2-week period where no Fed speakers were allowed to talk. It was in their blackout period. But then they had their meeting on December 13th and 14th, and Powell at that meeting pivoted. He basically said, yeah, now it's time to talk about rate cuts. So again, you had the market make this big jump. And we kept rallying essentially into the end of the year. We had a little pullback, but we quickly reversed it. And from low to high, the market rallied about 17% from the October lows. So that brings us to 2024. Now, why do we think that the market might be setting up to put in a major top in 2024? Well, there are 3 reasons. One is that we think the market is likely to rally well into 2024. But at the present time, the valuations for the market are already near bubble territory. They're at levels where historically the market has not done very well over the ensuing years. They're at levels where it's not the time to buy and hold equities. And then the last reason why we think that the market is setting up to put in a major top that could last years, is that we are currently in a secular bear market in equities. Now I could hear you saying, well, we're at all-time highs. How can we possibly be in a secular bear market in equities? I'm recording this, by the way, on January 18th. So the S&P, I think, actually closed at a new all-time high today. The NASDAQ certainly did. So how can we be in a secular bear market if equities are at new all-time highs? Well, secular bear markets don't mean that stocks just continually go down. What it means is that stocks don't outperform inflation. And if you look, since the peak in 2021, in December of 2021, inflation's up 11% and stocks are essentially flat. So stocks are underperforming inflation by 11 percentage points. Moreover, earnings are also underperforming inflation by a significant amount. So that is how we arrive at the fact that we're in a secular bear market, and we'll talk much more about that later. But these are the 3 reasons, and we'll delve into each one separately. Okay, so we think the market is likely to rally well into 2024 for a couple reasons. One is that the strong momentum that we saw in November and December of 2023 tends to have aftershocks that then lead to higher prices 3, 6, 9, 12 months later. Now, I mentioned earlier that a Zweig breadth thrust triggered, and it's a rare signal. It's only happened, I believe, 17 times, if I counted these correctly, since 1945. And each one, 12 months later, the market was higher by an average of 23%. Now, just because it happened in the past doesn't mean that this Zweig breadth thrust will pan out in the same way. The market could lose money over the next 12 months. But the track record is pretty strong, and it's usually an indication. When you see a Zweig breadth thrust trigger, it usually means that there's a huge appetite for equities, and that carries over in the ensuing months. And so, given that triggered, there's a decent probability that the market is going to rally into 2024. Another reason is that financial conditions are pretty loose at the moment, and they eased by the most over a 2-month period ever, or at least on record, in November and December of 2023. So you have easy financial conditions, you have a lot of bullish momentum in the market. If you look at the NASDAQ, if you look at the Zweig breadth thrust indicator, and in order for a Zweig breadth thrust to trigger, certain conditions have to be met. If you just look at the indicator itself without those conditions and see what level it's at, every time that the Zweig breadth thrust has crossed above 0.615, the NASDAQ, and that's happened 82 times, and NASDAQ has been up 81 of those 82 times 12 months later. So that's a pretty strong bullish indicator. Now, the one time it was down, it actually lost a lot of money. It was during the great financial crisis. But 81 of 82, that's a pretty solid track record. Another thing to keep in mind about the NASDAQ 100 is that in June of 2023, the NASDAQ 100 rose more than 20% above its 200-day moving average. Now, since 1985, that's happened, I believe, 16 times. And 15 of those 16 times, the market was higher 12 months later by a median return of 25% and an average return of over 30%. And the one time that it wasn't up, it was down, I believe, 9%. So another strong indication that this bullish momentum could carry over into 2024 for the NASDAQ and for the S&P 500. Also, it's a election year in 2024, and we have a first-term president who's up for re-election. Now, that's happened 10 times in the past where you had a first-term president that was up for re-election, and each of those 10 times, the market was higher in that election year. And the economy has been essentially propped up by deficit spending by the government. There's no reason to believe that they would stop that now in an election year, so the economy is likely to be relatively robust. The momentum, if it carries over in equities, that will also be beneficial for incumbent politicians. So we should expect that to happen. And so you have the momentum and you have an election year. Those could conspire to see equity markets higher in 2024. But if equity markets move higher from here and the valuations are already in bubble territory or very near bubble territory, how much upside is remaining? That's the question that we have to ask. So the indicator that we like to look at is known as the aggregate investor allocation to equities, or the AIAE for short. Now, this indicator was proposed by someone who goes by the pseudonym of Jesse Livermore on Twitter, and who has a website called philosophical-economics.com. And I urge you to check it out if you're interested. There's a lot of good material there. A brilliant guy. So the AIAE is essentially, you take the total market value of equities and you divide it by the total market value of equities plus bonds plus cash. So basically you're finding what percentage equities are of the total market of equities, bonds, and cash. It's basically the market's allocation to equities. Now, this indicator has a very strong relationship to 10-year forward equity returns. When this ratio is high, equities have poor performance over the next 10 years. When it's low, equities have very strong performance over the next 10 years. And you can perform a regression with returns and this indicator and come up with a relationship between expected 10-year forward returns and the AIAE. And right now, the regression that keeps expanding as more data comes in says that expected returns are equal to 0.2991 minus 0.5806 times the AIAE. So after the Q4 2023 rally, the AIAE stands at 0.486. If you plug in 0.486 into this equation here, you get an expected return on an annualized basis over the next 10 years for equities of only 1.75%. So if we look at this chart here, this is basically a chart of the AIAE from 1970 onward. And here in 1982, the market had been selling off essentially, and it was in a bear market, but it reached such a low level that the market essentially had nowhere to go but up. And this was here in 1982, the start of a secular bull market that culminated in the dot-com bubble of 2000. And when we got to the year 2000, the AIAE was at 0.527, its highest value on record. And what happened from there? Well, we had the dot-com sell-off where equities, the S&P 500 lost 50%, and the NASDAQ 100, and the NASDAQ in general lost over 80%. It bottomed here and it rallied into 2007, but then we had the great financial crisis, and the AIAE bottomed at 0.262 in 2009, which is around the time where we started a new secular bull market. And it went from 0.262 in 2009 all the way up to 0.518 at the end of 2021 when we had the everything bubble. Stocks rallied, bonds rallied, real estate rallied, commodities rallied, gold rallied. We had this everything bubble, and the AIAE was at 0.518. So then in 2022, the indicator came down, but after the rally in 23, it's now back up to 0.486. So it's quite close to this to the areas where secular bear markets started, and it's quite far away from where secular bull markets have started. So it's unlikely that there's a lot more upside to this ratio, which means that it's unlikely that there's a lot more upside to equities. Now, the current value of the AIAE is in the 95th percentile, and if you want details on these calculations, there's a paper at the Social Science Research Network called Towards a Better Fed Model. All the details of the calculations involved with the AIAE are in that paper. Now, we can take the AIAE and the regression equation, and we can compute what the expected returns are through time. So this black line here shows what the expected 10-year forward returns are based on the AIAE's prediction. And you can see that the most recent prediction as of middle of January is 1.7% annualized over the next 10 years. The blue line is what the market actually performed. So you have a forecast, and then what did the market actually deliver? So here at the start of the secular bull market in 1982, the AIAE was forecasting 18.9% annualized for the market. So 18.9% per year for as long as for 10 years. And the blue line is roughly at about 17.5%. So it was a quite good estimate of what the equity market actually delivered over the next 10 years. If you go down to the dot-com bubble, the AIAE was forecasting minus 1% annualized for equities over the next 10 years. So 10 years from now, you'd be underwater. You would have lost money. You would have lost 1% on an annualized basis for 10 years. And what did the market deliver? It essentially delivered minus 1% annualized from 2000 to 2010. But then, as the market hit its bottom in 2009, in March of 2009, this indicator was forecasting 15.9% annualized for the equity market from 2009 to 2019. The market actually delivered 16%. So again, the indicator was quite accurate in what its forward forecast was for the market. Now, here in 2011, the AIAE was forecasting just shy of 10% for the equity market from 2011 to 2021, but we got 14%. And then here in 2012, it was forecasting 13%, and we got 17%. this deviation from this black line was caused by all of that liquidity that the Federal Reserve unleashed on the market during the pandemic. So, but you can see that this blue line is rapidly catching down to the black line. So assuming that that happens, and this does regain its tight relationship with the black line, we can expect somewhere on the order of 1.5 to 2% returns for the S&P 500 on an annualized basis from January of 2024 to January of 2034. Now, we can also look at the expected equity risk premium. And that is essentially taking the expected returns for equities and subtracting off the 10-year bond yield. So if our expected return for equities is an annualized value over the next 10 years, and the 10-year bond yield to maturity is what you would earn from holding that 10-year bond until maturity, we can see are equities more attractive than bonds, or are bonds more attractive than equities? So in 1982, when the secular bull market started that led to the dot-com bubble, equities were priced to earn 4.9 percentage points more than the 10-year bond. At the top of the dot-com bubble, equities were priced to earn 7.4 percentage points less than bonds. So equities were forecasting minus 1%, and the 10-year bond at the time was around 6%. At the bottom, of the great financial crisis, equities were forecasted to earn 15.9%. So that means the 10-year yield at the time was 2.6%. And so you had 13.3 percentage points more of expected return from holding equities from the bottom in 2009 until 2018 than if you held a 10-year bond. But now we're back in negative territory. So at the top of the everything bubble in late 2021, equities were priced to earn 2.2 percentage points less than the 10-year bond. Now again, we're back up to those all-time highs, but our expected return forecast is actually 1.7% versus minus 0.03%, but the 10-year yield is higher than it was at the top in 2021. And so again, we're holding equities over the next 10 years, you're likely to underperform the 10-year bond by 2.2 percentage points on an annualized basis. So again, you can see that equities are priced much closer to places where secular bear markets start than they are to where secular bull markets start. There's not much more juice left to squeeze in equities at their current levels. Now, we can ask, well, for the AIAE to forecast something more attractive, say 7% annualized returns, or 10% annualized returns, or 15% annualized returns, as it did at the bottom of the great financial crisis, how far would the S&P 500 have to fall? Well, fortunately, this is actually a pretty straightforward calculation. So we're going to do a little bit of algebra, a little bit of arithmetic, but we'll walk through it slowly, and we'll see what the picture looks like. Like, where does the S&P have to fall to in order to make equities attractive from a long-term perspective? So if we have a few definitions, so if we let MVE equal the total market value of equities, MVBC equal the total market value of bonds and cash, let ER stand for the expected 10-year annualized return of equities, then the AIAE is given by the total market value of equities divided by the total market value of equities plus the total market value of bonds and cash. Now, the expected return is given by this regression relationship, where we have a constant plus a coefficient multiplied by the AIAE. And alpha and beta from that regression are given as 0.2991 and minus 0.5806. Now, we can solve for the market value of equities using this equation and using this expected return equation. And we get that the market value of equities is equal to the market value of bonds and cash times the expected return minus alpha divided by beta minus the expected return minus alpha in parentheses. So we can use this equation. Now we know what alpha and beta are. We can specify what expected return we would like to see on equities, and the market value of bonds and cash has had a long-term growth rate of 6%. It grows very steadily. Bonds and cash get issued at a rate of about 6% per annum. So assuming that long-term growth rate holds, we can estimate where the market value of bonds and cash will be at any time in the future. And that allows us to solve for the market value of equities. So if we go here, we see that at the year end 2023, the S&P 500 was at 4,800. The futures were anyway. The total market value of equities was 66.8 trillion. The total market value of bonds and cash was 71 trillion. The AIAE was 0.485, and the expected return was 1.7% annualized over the next 10 years. If we assume that the market, the S&P 500, has a rally of 15% in 2024, that would bring the price of the S&P 500 to 5520. The market value of equities would be 76.8 trillion. If we assume that the market value of bonds and cash grow at their long-term rate of 6% per year, then the market value of bonds and cash would be 75.3 trillion. Then, using the AIAE equation, we solve for AIAE, and it's 0.505, and then we plug that in to this expected return equation using alpha and beta here, and we get an expected 10-year annualized return of only 0.6% per annum, not even 1% per year for the S&P 500 from the end of 2024 to the end of 2034. And inflation is likely to be much higher than 0.6% per year. The 10-year yield, the Treasury bond yield, is likely to be much higher than 0.6% per annum. So if the market were to rally 15% in 2024, the risk-return trade-off would be really poor for holding equities relative to other potential assets. Now, where would the S&P have to fall to at year-end 2025 if we assume a one-year sell-off, or year-end 2026 if we assume a two-year sell-off, in order for the expected return of the index to be 7%, 10%, or 15%? So let's look at a 7% expected return. Using this equation with a 7% expected return, we know what alpha and beta are, and we grow. So this is year-end 2025. The current value of bonds and cash, market value, is 71 trillion. If we extrapolate that forward to the end of 2024, it would be 75.3 trillion. If we extrapolate it forward again to the end of 2025 at 6%, it would be 79.8 trillion. So if the market value of bonds and cash is 79.8 trillion, what does the market value of equities have to be in order for the expected return to be 7%? Well, it would have to be 52 trillion. Well, if it goes from 76.8 trillion at the end of 2024 to 52 trillion at the end of 2025, that would be a minus 35% return, and that would take the S&P 500 down to 3580. Now, if we wanted a 10% return in order for equities to be worth buying and holding for the long term, then the market value of equities would have to fall further. It would have to fall to 41.6 trillion, which versus 76.8 trillion is a minus 48% drop. The S&P would have to fall to 2860 in 2025 in order for the AIAE to basically say, hey, there's now 10% expected return going forward. And if we look at other times where the market bottomed and where secular bull markets started, the expected return was double digits, and it was 15% at the bottom of the Great Financial Crisis. It was 18.9% at the bottom in 1982. So if the S&P were to deliver a 15% on an annualized basis, 15% return, then the S&P 500 would first have to fall to 1900 in order for there to be a 15% annualized return from 2025 to 2035, or from the end of 2025 to the end of 2035. So that's if we assume a one-year sell-off. If we assume a two-year sell-off, now the market value of bonds and cash will continue to grow, and the S&P 500 won't have to fall as much in order for the expected return to be 7, 10, or 15%. In the case of 7% and a two-year sell-off, the market would have to fall to 3790. For a 10% return, it would have to fall to roughly 3,000, and for a 15% return, it would have to fall to 2,000. So not quite as much as in the one-year sell-off scenario. Now, it's actually the case that the S&P 500 doesn't necessarily have to fall at all. If it just goes sideways and stays exactly where it's at, and the value of bonds and cash grows such that equities become a smaller and smaller portion of the total market of equities, bonds, and cash, then at some point the expected return will become attractive, even if it stays and doesn't go anywhere. But for the S&P 500 to be able to stay where it's at and still deliver a 10% expected return, given that bonds and cash grow at 6% per year, it would take 11 years of the market moving nowhere for it to build up a 10% expected return from 2035 to 2045. So you can see that the market, this suggests that the market is quite overvalued at where it's at. And if we go back to these charts, we see again that these valuations are much closer to bubble territory, to where secular bear markets start, than they are to where secular bull markets start. There's not a lot of upside potential in equities if this relationship continues to hold between the AIAE and forward returns. Here is a chart of just the trajectories of where the S&P 500 would have to fall to if it engaged in a one-year sell-off. So a one-year sell-off, let's say it rallied into the 5,000s, it would have to fall to 35.80 for a 7% sell-off, to 28.60 for a 10% expected return, and to 1900 for a 15% expected return. That's a pretty large fall in 1 year. If we break this up over 2 years, each case isn't as steep. To get a 7% expected return, market would have to fall to 37.90. That's essentially where it was at the beginning of 2023. It would have to fall to 3,000 if it were to price in a 10% expected return, and it would have to fall to 2,000 if it were pricing in a 15% expected return. Now, of course, the sell-off could last more than 2 years, and in which case it wouldn't have to be as steep, but it would still be, this might be 2,100 for the 15%, this might be 3,100 for the 10%, and this might be 38, 39, 4,000 for the 7% expected return. So roughly same ballpark, but not quite as severe if the sell-off lasts longer. So now equities seem likely to rally in 2024, but there's not much upside based on where valuations are starting. And when you throw in the fact that we're currently in a secular bear market, at least from our perspective, and we'll explain why we believe that, most likely that secular bear market, the symptoms of that will start to reassert themselves, and equities will probably have a bumpy ride starting possibly sometime in 2024. So what are secular market cycles? So secular market cycles alternate between secular bull markets and secular bear markets, and these cycles last anywhere from 9 to 20 years each. Historically, secular bull markets have delivered 12% annualized returns relative to inflation. So if inflation long-term is 3% annualized, then secular bull markets have delivered 15% annualized returns. Secular bear markets, on the other hand, have delivered 0% annualized returns relative to inflation. So again, if inflation is on the order of 3%, secular bear markets have delivered about 3% annualized returns throughout history. And that actually lines up quite well with what the market is currently pricing in, 1.7% annualized. Now, the drivers of these secular cycles, there are 4 causes of these secular cycles, and they alternate. So we start the cycle, the meta cycle, with a secular bear market driven by low real earnings growth. After a secular bear market driven by low real earnings growth, we transition into a secular bull market driven by high real earnings growth. That gives way to a secular bear market driven by high inflation, which then segues into a secular bull market driven by disinflation, and then the pattern repeats. We go back to a secular bear market driven by low real earnings growth, and we continue with that pattern. So the current secular cycle is a secular bear market driven by high inflation. Now, given the definition of a secular bear market, one that delivers essentially 0 returns relative to inflation, since the top in 2021 in December, inflation is annualized at 5.4%. So over the last 2 years, from December 21 to say December 23, inflation's up about 11%. But the S&P 500 is essentially flat over those 2 years. Maybe it's up 1-2%. So it's underperforming inflation anywhere from 9 to 11 percentage points, which is much more indicative of a secular bear market driven by high inflation than it is any of the two secular bull markets that we just discussed. Now, prior to this secular bear market, the S&P 500 was in a secular bull market driven by high real earnings growth. From 2010 to 2011, real earnings, so earnings growth above inflation, came in at 7.7%. So whatever inflation was from 2010 to 2021, on an annualized basis, earnings outstripped inflation by 7.7%. If you compare that with the long-term real earnings growth, it's only 1.8%. So during that secular bull market from 2010 to 2021, real earnings were 7.7% versus a long-term rate of 1.8% in terms of growth. So that just, destroyed, crushed, dwarfed the long-term rate of real earnings growth. And that highlights the fact that we were in a secular bull market driven by high real earnings growth, and equities delivered 16% annualized returns. So that's totally in line with how secular bull markets have proceeded in the past. They've outstripped inflation by 12 percentage points on average. If inflation was, say, 2% from 2010 to 2021, and the market came in at 16% annualized, well, it outstripped inflation by 14 percentage points. So again, that's clearly a secular bull market. But now, since 2021, December of 2021, real earnings growth through June of 2023 was minus 10%. And if you look at the year-over-year predictions from analysts from December 22 to December 23, they're expecting minus 5% real earnings growth. So they're expecting earnings to fall by 1.6%, and inflation was, call it 3.5% in 2023. It's probably optimistic and probably a little bit on the low end, but nonetheless, real earnings were at least minus 5. Real earnings growth was minus 5% or worse. So again, minus 5% from the end of 2022 to the end of 2023 is a far cry from the 7.7% real earnings growth that we saw from 2010 to 2021. So it's an entirely different environment with respect to earnings, with respect to inflation, and it's much more likely, almost certain, that we're in a secular bear market driven by high inflation. We're not in a real earnings growth cycle anymore. The cycle seems to have flipped. Now, this chart looks at the broad U.S. equity market from the 1920s up to the present. So this blue segment here was the Roaring 20s. It was a secular bull market driven by disinflation. That led into the Great Depression, and that was a secular bear market driven by low real earnings growth. If you look from 1929 to 1949, real earnings were essentially negative until maybe 1948. From 1929 to about 1948, real earnings growth was negative. So that's clearly a secular bear market driven by low real earnings growth. But after World War II, the U.S. essentially had all the manufacturing capacity in the world because our competitors on the world stage had been essentially bombed during World War II, and they didn't have the capacity. They were rebuilding. So the U.S. had this open playing field to generate high real earnings growth, and that's what drove the market from 1949 to 1965. Now, after secular bull markets driven by high real earnings growth, that leads into secular bear markets driven by high inflation. And from 1965 to 1982, we had high inflation. The CPI annualized at, I believe, 7% from 1965 to 1982. So we had high inflation, we had deficit spending to fund the Vietnam War, Nixon closed the gold window, the dollar was getting weaker, and Europe was essentially exchanging dollars for gold. All of our gold was going over to Europe. Nixon shut that down. We had the oil crisis in 1973, so that was very clearly a secular bear market driven by high inflation. The market annualized 5.3% on an annualized basis from 1965 to 1982, while inflation annualized 7%. So stocks underperformed inflation by 1.7 percentage points per annum over those 17 years. Now, after a secular bear market driven by high inflation, we get a secular bull market driven by disinflation. So Volcker came on the scene, the Fed chairman, in the late 70s, and he raised interest rates as high as 20%. He essentially squashed inflation, and inflation came down over the next 20 years, and equities and bonds rallied together. And that culminated in the dot-com bubble in 2000. And from that point, we segued into a secular bear market driven by low real earnings growth. If you recall, during the dot-com bubble, the stocks that were driving that bubble had no earnings. And then again, in the great financial crisis in 2007 to 2009, earnings essentially vaporized and earnings just completely disappeared. So again, that was quite clearly a secular bear market driven by low real earnings growth. From 2000 to 2010, the S&P went sideways. From 2000 to 2010, earnings went sideways. They didn't grow at all. So again, that's kind of smacks you right in the face. That's a secular bear market driven by low real earnings growth. But we then transitioned into a secular bull market driven by high real earnings growth from 2010 to 2021. And that's where you had the emergence of the Apples, the Googles, the Metas, Amazon, etc. They had high, earnings growth, and the market followed suit, and it annualized 16% from 2010 to 2021. But in 2021, we essentially culminated in the everything bubble, and the AIAE was forecasting minus 0.3% annualized returns over the ensuing decade, and inflation reared its ugly head. Inflation, I think, reached as high as 8 or 9% in 2021, and the Fed had to start raising interest rates, and that essentially led us into a secular bear market driven by high inflation, where real earnings growth has been negative the last 2 years. The market has underperformed inflation over the last 2 years. So again, it's a pretty clear-cut indication that we're in a secular bear market driven by high inflation. Now, these secular cycles tend to last 9 to 20 years, and we're only a couple years into this. So, this could last for the remainder of the decade. And as you saw, the AIAE was forecasting very low returns for the next decade. So it's unlikely that this secular bear market is going to go away anytime soon. But when it does, it will give way to a secular bull market driven by disinflation. Somehow we'll solve the inflation problem. Inflation will come down, equities and bonds will rally, and we'll have a secular bull market. But we're not quite there yet. So again, just going back to these charts, we see that 1.7% is much, much closer to this bubble territory, to where secular bear markets start, than it is. It's not even anywhere near where secular bull markets start. And again, the equity risk premium is negative, and secular bull markets start when it's positive. So almost certainly we started a secular bear market at the end of 2021, and we're still in it based on where valuations are, where the relative pricing of equities and bonds are, etc. So to summarize, there's compelling historical evidence that the market could perform well in 2024. We have, it's an election year, and we have all these bullish studies that historically have led to higher returns 12 months forward. But the higher the market goes in 2024, the lower the expected returns will be, and they're already at a very low level, right around where secular bear markets start, and right around bubble territory. Now, the market, as Benjamin Graham once said, in the short term, it's a voting machine, it's a popularity contest, but in the long term, it's a weighing machine. And we believe that the weighing machine characteristic of the market will reprice risk so that there's a sensible trade-off between risk and return. Right now, with the very low equity valuations, given where the 10-year yield is, and given what inflation is likely to be over the next decade, 3, 4, potentially 5%, if it's anything like the secular bear market driven by high inflation in the 1960s, 70s, and early 80s, it would be 7%. Let's say it's not quite that high, but if it's 3, 4, 5%, if equities are currently priced to deliver 1.5% returns, you're going to have negative real returns. You're going to lose out to inflation. Now, for the market to price in a sensible trade-off between risk and return, the S&P 500 would have to fall somewhere around 30 to 40%. So if we were looking for a 10% expected return in equities to hold those over the long term, the S&P would have to drop to 3,000. And if the S&P crosses 5,000 this year, then dropping to 3,000 from above 5,000 is more than a 40% sell-off. So if the market does rally in 2024, you're likely to hear a lot of hype by the media, the financial media, telling you that everything's great, stocks can only go up, and it will be trying to coerce you to buy into that rally. But the people that will be selling to you will be the smart money, the people who bought the market in October of 2022. They'll be selling their shares to the people that are arriving late to the party in 2024. So keep that in mind. Now, how could this forecast go wrong? Forecast for a major top in 2024, how could it go wrong? Well, there's a couple possibilities. One, the market can rally in 2024 and then keep rallying in 2025. But if that happens, then we're likely going to see an even bigger bubble than the dot-com bubble. So things won't be getting any better, they'll be getting worse, and the eventual comeuppance for the market to restore a healthy risk-return balance will be that much more unpleasant. Another way that this could be wrong is that maybe the market's topped already. Maybe it's not going to rally into 2024, and maybe we just start going down now indefinitely. That's a possibility, but I think given the fact that we have an election year, given the fact that there's a strong desire by the establishment for equities to rally, because when equities don't rally, tax receipts fall. And tax receipts fall because you don't have as much income from capital gains taxes. If tax receipts fall and they don't cut their spending, deficits explode. If deficits explode, that means more treasury bond supply, which is what has caused the problem in October of 2022 and in October of 2023. The bond market was dysfunctional because there was so much supply that investors said, hey, we have to buy these at lower prices. There's too much of it and there's not enough demand. So the establishment wants to avoid that at all costs. So they're very happy for equities to go higher. So they'll keep the economy afloat with deficit spending. They'll probably cut rates. The Fed will likely cut rates several times in 2024. And then you had all that bullish, all those animal spirits at the end of Q4 2023 that tend to have aftershocks 3, 6, 9, 12 months later where equities continue to do well. So while it is possible that the market may have already topped, we think it's more likely that it's going to rally into 2024. And we think it's less likely that it will continue rallying into 2025 just because at some time in 2024, the market is likely to wake up and realize that, hey, there's really not a lot of juice left to squeeze here. There's not a lot of return given the risk that we're taking. And we think that is when the market will put in a major top for the next several years.